80% of all of the mortgages that were outstanding as of March of 2022 are coming up for renewal in 2024. But in 2022, the average fixed rate on a 5-year mortgage was 1.97%. Today, everyone is so keenly aware that renewal rates are much higher. In today's video, we're going to help you get some great ideas on how you can survive renewing your mortgage in today's sky-high interest rate environment. Let's get started. If you're a Canadian worrying about your mortgage renewal in 2024 and you have a really low rate, you're not alone. Most other Canadians are in the same boat. Over 80% of mortgages are up for renewal in 2024, affecting about 3 million Canadians. This means a lot of people are concerned about possibly facing higher interest rates. The Bank of Canada predicts that by 2027, monthly mortgage payments could go up by as much as 54% for some borrowers, adding even more stress to their situation. So what do you do about it? Well, in this video, we're going to share 5 simple but great ideas that you can use before and during your mortgage renewal to help you through this very tough time. And if you combine one or all of these strategies, you should be able to confidently get through the tough year ahead on your mortgage renewal. But burying your head in the sand and hoping it will work itself out is not the answer. Being proactive can help you deal with rising rates better and help you feel more confident about renewing your mortgage. So let's check out these 5 incredible tips to help you get ready and make smart choices with your mortgage. Number 1, don't just renew at your bank, use a mortgage broker. This is often a really great thing to do, even if you're not facing a high interest rate renewal. When you renew your mortgage at the bank, it's highly unlikely you're going to get their best rate right away. From my experience in working with clients and in handling my own mortgages, I found that the rates that the banks offer you at first are usually a lot higher, anywhere from 50 basis points to even a full percentage point higher than what you can get at another bank or credit union. In fact, it's only when you mention that you're going to move your mortgage that they might suddenly offer you a better rate. And by the way, it's still highly unlikely to be their best rate. And it's very likely you will still, even after they've lowered it, get a better rate at a competing bank or credit union. But applying for a mortgage at many different banks and credit unions can be a real hassle. It means gathering lots of paperwork, meeting with different lenders, applying at multiple places, and comparing rates, all of which take up a ton of time and effort. And after doing all of this, you might find that the potential savings of a mere half percentage point on your mortgage might not feel like it's worth all that trouble. This is where mortgage brokers can step in to save the day. They take care of all of the hard work for you. They find the best deal that suits your needs without all of the stress in dealing with multiple lenders yourself. A mortgage broker is a licensed professional. They are charged with helping secure a mortgage for you, their client. They function as an intermediary between you and many potential lenders, not just one. They offer great guidance and ensure the accuracy of all of your paperwork. Additionally, when mortgage brokers engage lenders, their services generally come at no cost to you. This is because the lender pays them directly upon the successful closure of the mortgage. Not only that, when dealing with major banks like TD, BMO, RBC, or others, you'll need to apply separately to each one to determine your pre-approved amount. This could cause what are called hard inquiries, and each time you apply, it can slightly reduce your credit score, hampering your ability to get your mortgage quote at the next bank. A hard inquiry or hard hit is done by a lender and it shows up on your credit report for anyone who asks to see it. Examples of when you might have a hard inquiry would include things like applying for a credit card, loan, job, or rental agreement. On the other hand, a soft inquiry, also called a soft hit, is when someone checks your credit report, but it's just for your own eyes. It doesn't affect your credit score and nobody else can see it. Soft inquiries include when you want to see your own credit report or when companies need to update the records about an account you have. Mortgage brokers offer a convenient one-stop solution for clients by providing access to a wide range of potential lenders. With just one credit inquiry affecting your score, they can explore numerous options for you. Often they will help secure you the most competitive rates and the fastest approvals. renewals. In short, what a mortgage broker can do for you is you provide your information one time to a mortgage broker, and they essentially take your mortgage and shop it around to multiple institutions, and they find the best rate for you. Best of all, they get paid by the lender, so there is usually no additional cost to you. Mortgage brokers are also very flexible in scheduling and communication. Many are available beyond regular banker's hours, are generally far more reachable, and are open to conducting meetings and handling essential paperwork through text, email, and platforms like Zoom or Teams. For those who prefer a more private approach, engaging with an online mortgage broker allows for transactions without the need for face-to-face meetings. Mortgage brokers are also generally able to get their clients approved even when banks deny them because they work with so many different lenders, including credit unions and private lenders. So if you are someone with a less than perfect credit score or have a unique financial situation, mortgage brokers are generally a lot more successful in getting you the loan you need. Number 2, if possible, try to make as many lump sum payments on your existing mortgage without penalties. Making as many lump sum payments as possible towards your mortgage without facing penalties can significantly reduce the amount you owe before your mortgage matures. Many financial institutions allow you to put down up to 20 or even 25% of your mortgage balance each year without incurring any penalties. Not only can this strategy lead to a substantial savings over time, but it can lower the amount you owe when it comes due. If your mortgage comes due during a period of high interest rates, by lowering the principal amount owed, even in a high interest rate environment, you could meaningfully offset the impact of higher payments, making your mortgage more manageable in the long run. Number 3, increase your amortization period. Now, increasing the length of your mortgage amortization, although it is not the most ideal solution, could provide temporary relief by reducing your monthly payments, especially during periods of high interest rates. By extending the repayment period, you can lower your immediate financial burden while still meeting your mortgage obligations. Now, you are going to pay a lot more in interest, and you're going to pay off your house a lot later, but this strategy does allow you to maintain ownership of your home and navigate through the challenges of high interest rates without risking default. However, it's essential to reassess your situation regularly and consider shortening the amortization should interest rates decrease. If you are currently on a 20-year term, thinking about moving to a 25, 30, or even a 35-year amortization period if it's available, this move could be worth considering to alleviate immediate financial strain and ensure sustainability in the face of elevated interest rates. Number 4, find extra work. Another strategy to cope with higher mortgage payments is to explore additional sources of income. Finding extra work through a side gig, side hustle, or a part-time job can help cover the additional financial burden of increased mortgage payments. By dedicating time and effort to supplementary income streams, you can bolster your financial stability and you can help ensure that you can make ends meet despite the higher expenses. Whether it's freelancing, tutoring, driving for a ride-sharing service, or taking on weekend shifts, leveraging your skills and resources to generate extra income can provide valuable support during challenging times. This proactive approach allows you to maintain your mortgage payments without compromising your overall financial well-being. The average mortgage payment in Canada rose from around $1,415 in 2019 to $1,984 in the first quarter of 2023. This represents a significant increase of just over $500. Now, according to this other calculator, link in the description below, the increase could range anywhere between the over $500 to over $700. If you are single, you will have to make an extra $161.53 per week to stay afloat. If you're married, it should be a little bit easier because this means both you and your spouse would need to only find an extra $81 per week to cover the additional mortgage payments if you're both employed. Now, while this may feel tight and, let's be honest, somewhat unappealing, it's not impossible to manage with careful budgeting and potentially seeking additional sources of income. Number 5, consult with an investment advisor portfolio manager. Consulting with an investment advisor portfolio manager can be instrumental in identifying additional sources of savings within your current investments and expenditures. By reviewing your investment portfolio and financial statements, these professionals can offer insights and strategies to optimize your returns and reduce unnecessary expenses. They can help you reallocate investments, minimize fees, and maximize returns, potentially freeing up funds that could be used to offset the increased mortgage payments when they come due. Additionally, they can provide guidance on budgeting and managing your finances more efficiently, allowing you to make more informed decisions to bridge the gap between your current income and your mortgage obligations. Collaborating with an investment investment advisor portfolio manager can thus serve as a proactive step towards helping ensure financial stability and meeting your mortgage obligations with confidence. Here's the bottom line. Navigating the challenges of renewing your mortgage into a potentially higher interest rate environment requires careful consideration and proactive planning. Whether it's exploring alternative lenders, making additional lump sum payments, or seeking extra sources of income, there are numerous strategies available to mitigate the impact of rising interest rates. Consulting with professionals such as mortgage brokers, investment advisors, or portfolio managers can provide invaluable guidance and support in making informed decisions tailored to your individual financial circumstances. By taking proactive steps and leveraging available resources, you can navigate through the complexities of mortgage renewal with confidence and help secure your financial well-being for the future. Did you know that navigating the uncertainties of the markets and your finances is generally smoother with the guidance of an investment advisor or portfolio manager? Studies have consistently shown that individuals who work with investment advisors, portfolio managers, tend to accumulate a net worth up to 3 times higher on average compared to those that go it alone. But that's not all. There's a significant impact on overall well-being, with those who seek professional advice exhibiting higher levels of happiness and lower anxiety. Do you want to know an easy way of identifying what kind of plan you have at work? Or maybe you want to find out more about what the silent killer of your returns is? Well, I've got everything already queued up and ready for you to watch. Click here for more amazing financial insights. I'll be waiting. We'll see you soon.